Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is our latest offering, What's Hot, a show that focuses on the biggest buzz on the D Street. Well, the earnings season has kick-started. As of yesterday, we've seen two IT bellwethers report their numbers, TCS and HCLTech. Both have managed to report slightly ahead of the street estimate kind of numbers. Of course, we will be getting into details of both these numbers with our guest today, decoding the environment of the IT sector and how you should be approaching the sector amidst these earnings. We will also be focusing on the entire season as it is going to be panning out. Will this finally end the 6 quarters of a pain that we've actually seen as far as the earnings are concerned? That's something that our question will be to our guest today. We will also be focusing on the external environment, viewers, which has largely been responsible for the entire last week of volatility in the markets. Just yesterday, we did see some bounce return onto the D Street with some positive statements from of course, Sergio Gore, and that led to a lot of recovery. But again, today we are hearing talks about more tariffs as far as Trump is concerned. So we are trying to decode everything that you need to know. And of course, upcoming, the budget on 1st of February will be an important talking point as well. Let's welcome our guest on board, Mr. Deven Choksey, the MD of DR Choksey FinServ, is now joining in on the program. Warm welcome to you, Mr. Choksey, and good to have you with us on this special edition. I'm meeting you on air for the first time in the new year, so Happy New Year as well. And thank you so much for taking the time out. It's always good to be, chatting with you. And of course, amidst all of these important cues for the markets, your insights are going to be extremely valuable. Give us first an understanding of how are you looking at the markets overall amidst all of these external shocks, yet again making us feel it's a deja vu of the last year, the tariff shocks, the policy changes, the uncertainties that we are looking at, and of course geopolitics and the war-related concerns that are again emerging at the forefront, sir.
Yes, Sakshi, good morning and wish you happy 2026 as well.
Thank you.
Well, I believe that I think overall market is basically having a typical situation wherein on one side economy, industry, corporate earnings and consumer spending are all growing in a very systematic manner, I think, which is probably, I think, an enviable situation in the global market. India as an economy, as a country, as a industry, I think we are doing phenomenally well. That is what I think is a one-line summarization is. On the other side, the markets are troubled largely because of the fact that the global portfolio of funds are shifting out of the markets. And at the same time, adding to the problem is the high-cost IPOs in which I think most of the funds have invested. They are now struggling to maintain their NAV, and as a result of which, I think they are desperately booking out, even at a loss in some cases, I think their portfolio positions. So that is where probably I think you find a challenge that on one side the industry is doing well, earnings are doing well. On the other side, the markets I think are having trouble sustaining at this level, largely because of the fact which I mentioned about the high cost valuation which are seen unsustainable, at least in the portfolio for the time being. So due to the pressure of releasing money, I think the fund managers need to sell. And as a result of which, probably I think you are seeing the larger part of the damage happening after the FI sale.
Right. Mr. Choksey, do you think these last few days of talk on more tariffs from Donald Trump, of course, the Supreme Court's decision is awaited, but Donald Trump has also said that could be significant consequences if there is a strike down from Supreme Court's end as well on the tariffs. So he may be looking at other ways of, continuing with heightened tariff concerns even at this point in time. He's now talking about a 500% tariffs on all those countries importing from Russia. Overnight, there is an extra talk about Iran now and a 25% additional tariffs on all those countries which are dealing with Iran. How are you looking at all of this? And do you think this is making life tough for fund managers, for retail investors at large to plan ahead of how should they be putting in their money in the markets?
So any tariff-related threat is largely, I think, proving counterproductive as far as I think the whole country, America, is concerned. Though they may say that I think they have been successful in bringing down the trade deficit. However, I think the fact remains that at this point of time, the economy of America is definitely requiring good partners like India to supply to them in a China plus one situation. Now, if you want to raise 500% tariff, of course, I think you should, and I think see how the consumer reacts thereafter in the country, and that's where probably you are going to have a challenge. In my viewpoint, I think it's not easy. It's not sustainable either. Maybe I think the need is to arrive at a trade agreement between the two countries, which is waiting for a longer period of time, which is creating a good amount of frustration, as can be seen. In my viewpoint, I think the tariff threat is not real. Even if it happens, it's not going to sustain. On the contrary, with the signing of this trade agreement, which is all likelihood happening, my reading says that I think the stalled exports of Indian industries, say for example shrimps or for example textiles, I think those companies which are in manpower intensive businesses, I think they will once again start seeing the breather. So let's hope for the best. I think let's not get bogged down with the threat of the tariff.
Right. On Iran specifically, are you already looking at some impact that we could probably have? Because, major Indian exports to Iran include rice, tea, sugar, pharma, even electrical machinery, artificial jewelry as well. We have the Chabahar port also. Are you looking at any kind of an impact coming in?
That is again, I think, a very serious issue which has happened, and I think is probably, I think, reaching in a stage where I think the entire situation globally is getting very, very disturbed. Can't immediately say, I think, what could be the impact on each and every commodities that you have mentioned, and neither, I think, the operations of the port, because port remains, I think, a critical asset. So obviously, I think, as a country, they first protect, I think, those assets, goes without saying. So in my viewpoint, I think at this point of time, one can only hope that the situation gets normalized. And if it is getting worsened, certainly, I think some of the names of the commodity industry that you talked about, we'll have to look at them. As of now, I think no impact for sure.
Okay. How would you look at yesterday's positive statements from Sergio Gore coming in? We now have a person closer in Delhi to really probably look at a better communication with the US now that a person is placed here, and some positive statements coming in on the talks that are progressing well. He's also talked about PaxSilica and India's participation finally coming in after this entire year when we were not allowed to participate in that. Do you think the opening up of supply chains with regards to semiconductors and some of these new age spaces will augur well for India?
Yes, I guess I think very rightfully he has observed that I think India could be, I think, the best friend as far as America is concerned. And in this century, probably, I think this kind of friendships would not be happen again, I think, if it is broken. Yes, I guess I think this is the right statement to make. Maybe I think the country as a whole is quite large. India as a country, I think, unlike America, America may have a major landmass, but India is having a larger population. And I think that population is basically required to be taken care of. That is what is understood clearly by the ambassador. I believe that I think he is very clear focus in putting across the right message to Washington, wherein probably I think he is going to communicate that I think this is where the country requires to protect. I believe that I think somewhere the balance will strike and the deals are going to get through. That is what one can probably hope for. It's good time of 1 year which has passed, and I believe that I think it's time when probably I think the deal needs to strike. Let's hope for the best. I believe that I think things are getting normal.
Okay, let's come back closer home and try to see all those triggers that are emerging at hand. The earnings season has kick-started, albeit on a better note than expectations on both HCLTech and TCS reporting slightly ahead of the numbers that are coming in. Of course, there has been the labor code's impact on profitability, margins, but the positive aspect is with regards to the AI hiring that the companies are now doing and the focus from there. The revenues have picked up there as well. How are you looking at the earnings that have come in from both HCLTech and TCS? Which one did you find better? Where do you still see confidence that investors can go ahead now looking at this kind of a number despite some tinkering on the guidance front on the lower end as well?
Well, yes, I guess I think both these companies have had the situation wherein I think they had to account for the manpower retirement cost, I think, which we want to call it as. And that is what is basically seen impacting the PNL of the companies. If this particular amount, I think, is taken aside, then probably I think the business conditions are seen little improving and not otherwise. That is what I would like to put across as the first point. The second most important point, as far as the confidence is concerned, both TCS as well as HCLTech, both of them have squarely echoed the confidence, saying that they are engaging well with their clients and the larger amount of AI-based contracts are coming their way. In fact, numbers are speaking louder for HCLTech, wherein they have got the intake of around $3 billion worth of order book. And that's what possibly I think is giving a larger amount of confidence. TCS is on the other side talking very categorically that 2026 is going to be the better year for the company as a whole. And they are engaging with their customers for new contracts. So, yes, I think on one side, the coders are being replaced with AI for sure. But on the other side, I think the customers are engaging these companies largely to provide the solutions which are required at a faster speed compared to what one has seen in the past. So we do see, I think, a calibrated growth and the upside, both, I think, as far as the business is concerned for both these companies.
Devan sir, I will just read out what some of the brokerage houses are saying on both HCL Tech and TCS for the benefit of all our viewers as well, and then we will discuss a little bit more on both the ends. HCL Tech, we have Morgan Stanley's report, which has an equal weight rating, a target price of 1760 viewers. They believe Q3 has been a beat, and this has lifted the financial year outlook. They also believe FY27 growth visibility has now improved after this earnings. They believe margins can normalize near 18% now, and the estimates are likely to move higher, and that's a positive brokerage report on HCL Tech. Kotak Securities has a reduced rating even now, a target price of 1680, just about 40 rupees higher from where it is. Products have driven Q3 beat is what they believe. There have been strong deal wins. Services slightly better. Remember, there's been an upgrade on the services outlook by the company. There is limited margin expansion, they believe. Citi has a neutral rating, a target price of 1700. They believe Q3 deal TCV has been a beat. FY27 to 28 EPS has been raised by 2%. Their forward indicators are strong, remaining, however, cautious on the IT sector as a whole, is what Citi's report says. Macquarie has an outperform rating on HCL Tech, target price of 2080. That's the most bullish target that we have among all the brokerage houses that have reported. They see HCL Tech as a growth leader, expecting 18 to now 19% of EBIT margin in FY27. That's some of the earnings that have actually, the reports that have come in here. What is a realistic expectation, Devin sir, that one should have on HCL Tech when it comes to margins and the targets that you would want to draw?
So clearly the margins are going to be on expanding side for sure, because on the other side, as I was making a point, the coders are being replaced with the AI. So to a greater extent, I think the time to deliver as well as cost to deliver, I think both are in favor of the company, and they have been adopting AI very systematically. So there is no doubt, I think, that this is going to be a sustainable future for them. In my viewpoint, having talked about the margin, the next best thing that I think one can ask for the growth. Fortunately today, due to the disruptions created by AI, majority of the global corporates are basically, I think, at a desperate need to basically implement the solutions in their own domain. And that's where I believe that I think some of these companies hold a very good chance going forward in providing the product-based solutions to their customers. The only key factor that I think one has to look out for, how soon, how fast I think these companies, their customers, are releasing their orders, be it in the area of BFSI, be it in the area of health tech, be it in the area of, I think, any other insurance techs and telecom, etc. I believe that I think these companies, if they start demonstrating the order book, which is basically asked for, then probably I think you should be seeing relatively much better year in these companies, I think, in the current financial year and thereafter.
Okay. Let me just read out brokerage Houses reports on TCS also, viewers, so that you're all aware of as to how are some of the brokerages really looking at TCS post earnings. They have Morgan Stanley as an overweight rating, a target price of 35.40. They believe international business continues to be softer, but calendar year 2026 momentum is seen as intact. They believe that they are confident of margins moving from 25% to 26%. The FY26 exit growth is seen better than FY25. They also believe the AI revenues are now scaling up. Citi has a sell rating on TCS, target price of 3020. They have cut it slightly. Q3 they believe is in line, but growth is disappointing as per them. They believe equipment and software have definitely driven 50% of the growth. The core services momentum, according to them, is still weak. They also believe there are risks from AI productivity and GCCs. Kotak Securities has a buy rating, a target price of 36.75. Revenue, they believe, has been muted, but margins are stable. They believe there is a focus on mega deals, AI, M&A. FY26 is seen as an underperforming year, but growth is likely to improve in FY27, according to them. For TCS, Deven sir, what do you think will be the key watch for you going forward from here, if you believe the kind of erstwhile performance is to return?
In fact, I think very importantly, the company has moved in its business model, and while adopting AI, they have also gone ahead with the capital investment related activity in form of setting up the data center. In my viewpoint, I think this is the new reality. Anybody who has a computing power and services to offer would be the one, I think, whose customer would port onto their infrastructure. And that's what TCS has realized. In my viewpoint, I think having got some of the largest customers with them, it is very natural for them to build, I think, the activities in the area of data center, among others. So, and AI, of course, I think, is the driver. So, in my viewpoint, I think this is where probably this company is going to be a differentiator. Whether I think we want to, I think, see this particular company growing at 15-20%, answer should be yes. Wow, that I think immediately at least we are not saying it, but I think the stock price appreciation of 15-20% is distinctly possible as far as I think the outlook is concerned based on the fundamentals of the company.
Okay. If I have to draw some insight from the earnings that have come in for the larger sector as a whole, what would be the expectations from the other large caps and of course in the mid cap IT space as well, sir?
Third quarter is going to be the start of next few many quarters, wherein your earnings are likely to be showing remarkable jump in profitability. The first two quarters have been saddled with, I think, whatever the negative factors that were there. But in the third quarter and fourth quarter onwards, I think few important catalysts are emerging. Importantly, crude oil prices. If the global crude oil prices remain low, then we are talking about lower amount of inflation. The lower amount of inflation is basically the result of, it will result into rather lower cost of interest. And that is where probably I think the economy will get the kickstart as far as the capex program is concerned. So we remain distinctly bullish about the third quarter, fourth quarter going forward. Commodity driven upside cannot be ruled out given the kind of lower cost structure. Manufacturing driven upsides can't be ruled out again because of the higher amount of thrust due to PLI schemes, due to government spending on infrastructure, etc. So certainly, I think we believe that the amount of the growth prospects in the current year and next, I think, are remaining extremely convincing and strong at this point of time. We do believe that the profitability will not only sustain, but in some cases, I think, marginally go up as well in the given period.
Fair point. Let's now focus on the entire Q3 season, Deven sir, and try and understand whether this will be another quarter of mixed kind of results that we have been seeing over the last couple of quarters, or will this finally end the 6 quarters of a weakness that we've been looking at on a large space of Nifty earnings? Will there be real recovery? What are the sectors that you would watch out for outperformance vis-a-vis underperformance?
So consumer spending has indeed started, and I think due to the festive season October, November, I think that is having a positive impact on the corporate earnings for sure. each and every monthly data that you look at for many of the consumption areas, you find that the growth has been, I think, extraordinarily smarter and better. Automobile is one clear number indicator, wherein the new models are also kicking in. At the same time, I think the first time buyers buying the small cars, which was a program which got completely stopped in between, but due to GST cut, I think this has once again revived. And the first time buyers, the new buyers are buying the smaller cars. So this is a very good sign that one can see. So that at least I think the further process will continue, where I think they shift over to the premiumization theory, which is I think the premium models. In my viewpoint, consumption is indicating the third quarter is better. Commodity prices are indicating that the third quarter is better. Commodity consumption is indicating third quarter is better. In manufacturing also, when you look at the companies which have actually participated in under the PLI scheme as well, I think they are suggesting that I think the growth program is far better. So third quarter is going to be beneficiary across in my viewpoint as far as I think the companies are concerned. Maybe the victimization might slightly happen in the mid cap and small cap counters because they are the ones I think who are sandwich layer between the big supplier and the large customer. And that's when probably I think they will be tightly delivering their performance with the tight margins. The kind of growth momentum that we had earlier projected, market had earlier projected, that growth momentum is not sustaining. So maybe in some cases you might see the tapering of the growth. Maybe I think the realistic picture is that railways, defense kind of businesses have the long-term visibility, but their ability to grow is between 15 to 20% at the best. So any mid-cap companies I think which are basically assuming a growth in excess of 30-40%, they are going to be getting squarely penalized also in the market as far as the stock price is concerned. So third quarter is not going to be disappointing from the earning perspective. Definitely, I think it will have its own challenges as far as the market price is concerned. We may probably want to get readjusted in some point of time.
Right. Deven sir, now let's also focus last couple of minutes on the show. Also focus on the big trigger of the union budget coming up in a fortnight or so. This time around, it's going to be a Sunday budget, and we are hoping that this time around it will be also one of the firsts when we will see the stock markets also probably open. No official communication yet, but the expectations are large here because last time it was on a Saturday and we did see the stock markets open as well. This time it could be a Sunday market for all of us. How would you be looking at the big expectation, especially after the big bang announcements on the taxation front last time? Are you penciling in any other big announcements, or will this be, probably a non-event kind of a budget?
So, Sakshi, we'll have to work on this Sunday. I think that is what I think I am a little unhappy about. Well, I think the lighter in the side. I think the budget has provided for the tax exemption, and I don't think that government is going to be further giving any kind of bonanza in form of tax for sure. Maybe some of the procedural aspects, I think, related to tax, they may probably, I think, consider it well, so that at least I think the corporate earnings, I think, also sustain at the same time the growth momentum also gets picked up. I'm not too sure whether I think they will be giving any concession in the tax rate. In my viewpoint, I think they have completed the program of giving tax concession to corporate as well as to individuals. They will not be in a hurry to, I think, do so next 4 5 years now. The second point, I think, which I believe that the economy is requiring today, because of the free trade agreement that we are signing with various countries of the world, particularly European nations, and also I think bilateral trade agreement, including hopefully before budget, I think with America. In such situation, I think what will happen, the government will have to significantly, I think, give emphasis to 2 or 3 things. One, I think the logistic management, import and export of trade, which takes place, I think is requiring, I think, some amount of attention. There may be some kind of a incentive kind of program which may come up because the PLI is doing exceedingly well. So hopefully, I think the logistic part of activity, if it is basically incentivized, then economy can actually flourish in form of, I think, creating the infrastructure. So that is one aspect, I think, which we believe could be, I think, a good possibility. Second aspect, a good possibility is in the area of power. We believe that I think going forward in next 5 years, the cost of per unit of power might come down to somewhere around 5 to 6 rupees per unit, and against 8 to 10 rupees per unit for the industry at this point of time. And the reason for that cost coming down is also fact that I think the renewable segment of energy which is getting into the system. So the larger thrust government may end up putting would be in the area of power and power utilities. And that's where probably I think you might see some amount of soaps I think considered in this particular budget for this particular sector as a whole. The other areas where I believe that the digital stack in form of UPI, ONDC and digital currency, they are likely to be given, I think, the larger amount of thrust. India has already started dealing with 5 countries on a digital rupee. So fully, I think this experience travels faster than I think we are doing with the dollar as a currency medium for transacting eventually. So if that happens, probably I think it will be a long-term benefit for the country as a whole. So we believe that these are few possibilities, I think, which at the macro level are definitely, I think, considered. Some of them will have to be seen how exactly they influence the industry and their corporate funding workings, etc. But we remain distinctly hopeful. We also believe that semiconductor and data center related programs are going to be given incentive, and I think this can come into PLI scheme as well.
Can we at all hope for any relief on capital gains taxes? That's what the stock market investors have been looking forward to. That segment has been left out in all the taxation reforms. We have STTs, then we have GST, we have stamp duty, we have LTCG, STCG. Do you think this needs to be really looked at and some relief needs to be given to the retail investors, domestic investors that have been so far lifting the weight of putting the markets higher in the absence of FIIs?
If at all, I think you are asking for relief, I think it should be, I think, for investment. And if at all, I think the some amount of precautions or care that you want to take as an economy, then I think the speculative and excessive speculative activities, I think, could be coming under some kind of a adverse tax implications. If that is happening, then I think the objective is well achieved. But at this point of time, I don't think that the government has got many things on their card as far as these items are concerned. Neither they are likely to look at, I think, capital market related taxation structure at this point of time. If at all it is taken, I think it is going to be incentivizing long-term investors at the cost of short-term traders.
Okay, fair point. Thank you so much, Mr. Choksey, for being with us on this very special edition of What's Hot. Always a pleasure to have you with us. Of course, in the due course and the run-up to the budget and the earnings ongoing, we will have a lot of opportunities to seek more insights from you. Thank you so much for being with us.
Thank you so much and wish you all a good day.
Thank you so much. All right, viewers, the markets are also turning green, and that's a positive sign yet again. 25,800 is back on the screen now. We've turned green just coming off from the day's lowest point, and let's see how things really pan out in trade throughout the course of the session as well. Stay tuned with us onto Business Today Television. The market coverage will continue on the other side. There are lots of earnings conversations lined up for you, so stay tuned for that as well. I'll be back at 12 noon to answer all your queries on Daily Calls now.
The world's most powerful double-engine coverage, where access meets expertise. Davos Brainstorm, 19th to 23rd January, only on India Today and Business Today.